Does the 5-year rule sound overwhelming when you start talking about Roth IRAs? Well, I'm going to tell you it is. We brought on an expert. This is all she does. Her name is Denise Appleby. She is an expert with IRAs, 401ks. You want to listen to this episode to understand the 5-year rule.
To learn more about how to secure your retirement and all the different elements you need to know, please subscribe to our channel and hit the bell so you'll be notified when we release episodes every Monday. We have helped hundreds of our clients gain clarity and get on the path to a great retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement Podcast. We are certainly happy to have you with us today and talking. We're going to be talking about a topic I think that a lot of people get confused about. In fact, Merce and I did an episode ourselves on the Roth conversions and the 5-year rule and whether it be funding or not funding. We've had so many questions on that this year. We actually thought we would bring on the person that we go to get our questions answered. And she is an expert in all things IRAs. Her name is Denise Appleby. So Denise, thank you so much for coming back on. You've actually been on the podcast before, so we appreciate very much you revisiting with us.
Absolutely. Thanks for having me on. Always a pleasure.
Good. So we really kind of wanted to go back in, when Merce and I did the episode, we basically took a lot of notes from actually our conversation and tried to lay those things out. But honestly, there's a lot of different parts of the 5-year rule. In fact, when on our episode we did, Denise, we only talked about somebody over 59 and a half. So today we kind of want to talk the under 59 and a half and the over. So as we get into this topic, I think I just want to start it right off and say, could you just tell us high level, what is the 5-year rule and what are we even talking about when we say 5-year rule?
Okay. And I'm so glad you positioned the question that way, because I want to correct you a little bit and say, what are the 5-year rules, right?
Okay.
Because I think that is the point of confusion for a lot of people, the fact that we have two separate 5-year rules. And so when you're having that conversation with clients, the challenge is, or the goal is to determine which 5-year rule applies to the client. The first 5-year rule is used to determine if a Roth IRA distribution is qualified. And for that 5-year rule, it starts January 1 of the first year for which you fund your Roth IRA, and it never starts over. So if you funded your first Roth IRA in 2010 and you emptied out that account, has a zero balance, come 2023, you start a new Roth IRA. When does that 5-year period start? January 1, 2010. Now, the second 5-year period, you go to only if you're not eligible for a qualified distribution. And so part of what we have to do is identify what's a qualified distribution, right? You meet the first 5-year rule that I talked about on one of 4 requirements, which I know you're going to get into later. If you meet those 2 requirements, then you don't care about the second 5-year rule. But if you're not eligible for a qualified distribution, then you go to 5-year rule number 2. And 5-year rule number 2 is used to determine if a distribution of Roth conversion amounts are subject to the 10% additional tax or early distribution penalty. Now, this one's different because it applies only to conversion amounts or rollovers from pre-tax side of employer plans like 401ks. And it starts every year that you have one of those transactions. So if you do a Roth conversion in 2020 and you're taking a distribution, the distribution comes first from a conversion that you do in 2020 before one that you would do in, say, 2023.
So if you're listening already, you can understand that there are some nuances here that we need to understand around what the 5-year rule is. And I think the reason that we're bringing it up as a full-on podcast topic, and we've had a previous episode on, is because we are talking tax strategy right now with a lot of our clients. And part of that recommendation or something that can become an opportunity is, hey, taxes are somewhat on the lower side right now. We know taxes are going up in 2026 unless there's significant legislative change. So a lot of our clients right now are doing Roth conversions, but it's not as simple as deciding to pay the tax and then also or deciding to pay the tax, get the money in the Roth account. Now you're good to go. It's also, we got to understand some of the nuances of the Roth and the 5-year rule. Now, I think most of our clients are going to be in the scenario where they're really doing a Roth conversion for future potential use way down the road for their own retirement, or they are doing it for their legacy. They're going to leave this money behind. And so for a lot of our clients, the 5-year rule really isn't going to apply all that much, but it's still something that we need to understand. So Denise, can we do this? Because we also have plenty of listeners that are going to be in the age of, say, 50 to 55. They're the key thing here is that they're under 59 and a half. So can you speak to that crowd that is under 59 and a half? Let's just go with the example of someone that's 50 years old right now. They do not have a Roth account, and they have an opportunity to start doing Roth conversions because of their income situation is low. So we've deemed that a Roth conversion makes sense. They've never opened a Roth IRA in their life, and they're under 59 and a half. Could you walk us through an example of what that specific person needs to be thinking about?
If they're going to be taking distributions?
Well, what they would want to think about if they're going to be taking distributions, yes, before the age of 59 and a half. And then we can go.
Yeah. The goal is wait until I'm retired to start taking money out, but then life happens, right?
Yep.
So you're age 50, under 59 and a half, and you need to take money from your Roth IRA. If you haven't had the Roth IRA for at least 5 years, and we still have to talk about the 5-year period, because you could be under age 59 and a half and you're still eligible for a qualified distribution. But let's assume that this person is not eligible for a qualified distribution because, as you said, it's a new Roth IRA, so they haven't met the 5-year period. If that person takes a distribution from the Roth IRA, we have to go to what is referred to as the ordering rules. And under the ordering rules, distributions are taken from a Roth IRA in a specific order. You have what I like to call as 3 tranches or 3 levels. Let me say levels because I can pronounce that better than tranches. So you have 3 levels, right? And, you got to say to yourself, where's my distribution coming from? Which level? And the first level is, so look at it like a cake and you're eating from the top of the cake, right? The top layer is your regular Roth IRA contributions. And if you rolled over any money from Roth 401k plans to your Roth IRA, that would include any basis that was rolled over too. So level 1, regular contributions, basis from Roth 401ks, Roth 403bs, Roth 457bs. You take those out first. They're always tax-free and penalty-free, right? When you've done with that level, you go to the second level, which is conversions from traditional SEPs and simples and rollover from the pre-tax side of, say, 401k pension plans. Those amounts, when you take them out, they are going to be subject to a 10% additional tax or early distribution penalty unless you qualify for an exception. And the question becomes, well, what are the exceptions? See those exceptions that apply to traditional IRAs? They also apply here, but there's a bonus exception, which says if you had converted that amount for at least 5 years, then you get an exemption to the 10% early distribution penalty. So in your example, where this person just started the account, which means they haven't funded the Roth IRA or converted the amount at least 5 years ago, they're going to owe the 10% penalty, but no income tax. Now, if they used up all of level 2 and now they're in level 3, that's earnings. That's going to be taxable. That's going to be subject to the 10% early distribution penalty unless they qualify for an exception. And so what I like to tell people is, okay, so you feel like you have no choice but to take money from your Roth IRA. Make sure that you stay away from level 3 because that's going to be taxable because it's non-qualified. And if you can, stay away from level 2 as well, because even though it's not going to be taxable because you paid taxes at the point of conversion, it's going to be subject to the 10% additional tax unless you qualify for an exception.
Okay. So that lays out some nice guidelines. I do want to, though, before we go on and continue to talk, because you brought it up right before we got into this particular question. So let's go back to this scenario of my conversions. And you said each time I do a conversion, I have basically, I think, a 5-year rule on each one of those conversions. Mm-hmm. Now, here's a tricky question maybe, but whose responsibility is it to track? Because I mean, if I do, let's say I do a $10,000 conversion over the next 5 years, and I now am, how am I knowing where I'm getting that money from, and I'm tracking that? Do I need to have like a, spreadsheet that says, hey, here's when I did this, this, and this? Like, how do we really need to think about that?
Yeah, ultimately, it is the customer's responsibility. The IRA custodian will not track this. There's no way they can, right? Because all of your IRAs are aggregated for that purpose. When it comes to IRAs, there's a lot of aggregation going on. You're aggregated for when you started the first 5-year rule. You're aggregated for what year you did a conversion. So you did a conversion in 2023, and you did a conversion in 2024, 2023 separate. The IRA custodian doesn't know if you also did a conversion somewhere else for 2023. And so the IRS says, custodian, if you don't know if they qualify for an exception, if you don't know if they are eligible for a qualified distribution, report it as a non-qualified distribution that does not qualify for an exception. And so now when you go to the CPA to file your tax return, you're going to have to show them proof that you qualify for the 5-year rule or any one of the other exceptions. Otherwise, you're going to owe the 10% early distribution penalty. And what I usually say to clients is, store those documents, like your Form 5498 that shows the contributions and the conversions. Store them in, say, like a Google file that you'll forever have access to, as long as you don't lose your password. Because sometimes we have so many mergers and acquisitions, you move over to custodian ABC, and 2 years later, they can't find a document that you funded your Roth IRA for the other firm that they moved over from, even though that they're required to. But sometimes things happen. So as taxpayers, we have to be responsible for protecting ourselves as is allowed under the tax code, or we're going to owe taxes, or we're going to pay taxes. We won't owe it, but we'll pay it because we don't know that we don't owe it because we don't keep proper records.
Okay, I want to build a little quick scenario for you, and then we'll move on to another question. So I'm going to use easy ages and math. Let's say I got a 60-year-old person who has had a Roth now for well over 5 years. Okay, so they're 60. They've got, let's say, $100,000 in their Roth, right? But last year they did a conversion. Right. So we're 1 year into this conversion. And so they did a conversion last year of, let's just say, so they had 100,000, they did another $100,000 conversion. So now they got $200,000 in their Roth. Now that one conversion that they did now, even though they're over 60, they had the Roth open, they've got to wait 5 years on that conversion before they can get to it. Am I understanding that right?
No. And I love the way you pose that question, because it allows me to answer the question of what's the purpose of the second 5-year rule. It's only to determine if you're subject to the 10% additional tax on a conversion, right? If you're over age 59 and a half, you don't owe the 10% additional tax. So you don't need to keep tracking the 5-year rule for conversions. You're home free. And in a case where someone is at least age 60 and has had a Roth IRA for at least 5 years, we don't track anything. All we need to prove is that you have met the 5-year rule and you're at least age 59 and a half. So that's a very nice place to be, no longer required to track anything. So if your client is at least age 59 and a half, the only question then becomes, have they had a Roth IRA for at least 5 years? right? And then if the answer is no, the only thing we need to be concerned with is level 3, because then distributions from that would be subject to ordinary income tax.
I'm going to say one thing here,
Okay.
and I'm going to let you.
I've got another example question too. Go
Okay.
ahead.
So very quickly, I want this, I think, to kind of come into somebody's head. And what I'm going to say at this point is, even if I only did a very small, little tiny conversion, I want to do something, I think, earlier than later to get my Roth open, so when I get down to that point, that I'm going to have it open, whether I do a contribution or a small conversion of some sort, right? Because I'm just trying to establish that I've got a Roth open. So, for me right now, we actually can do a Roth 401k. I cannot do a Roth contribution, right? For all the guidelines there, but I could do a small Roth conversion just to make sure I've got the Roth open.
Yeah. Excellent strategy. And I say that to everyone, start your Roth 5-year clock right now. Make sure it's legitimate, because that's part of what you alluded to. Can't be a regular contribution if you're not eligible, but it can always be a conversion. So use that to start your 5-year clock for qualified distributions.
So I'm going to go back to one more example, I think, to bring it home. Go back to my 50-year-old person. They've never had a Roth, but from 50 to 60, they're doing $10,000 conversions every single year from 50 to 60. So 10,000 for 10 years, 100,000 of conversions have made it into the account. So the way I'll say it back to you and tell me if I'm right. They opened the Roth. It's been open for 10 years. So our 5-year rule on that side has been checked. We've made it to age 60 before they need to take a distribution. So a qualified distribution rule has been checked. So am I saying it right that on any distribution going forward after they reach age 60 is going to be tax-free, no penalty, and they can tap into the growth without penalty as well?
Absolutely. Perfectly said. Yes.
Okay, great. So I've just got a curious question, because, legislatively, things are always kind of up in the air, right? The RMD age is moving around, has been moved around a lot in the last 3 years since the pandemic because of the Secure Act. Have you heard anything about, legislatively changes coming or that are on the table that hopefully never get passed around Roth IRAs and 5-year rules and tax-free growth? Have you heard anything around that?
No, I haven't heard anything. And as you know, a few years ago, they tried to take away some Roth provisions. They even included it in a draft proposal, right? But it never made it. And if you look at the provisions on the Secure Act 2.0, that's very Roth friendly. They've been adding a lot of Roth provisions. And my opinion is, I don't think Roth is going anywhere, because that's how the IRS gets their money, right? In traditional, it's tax deferred growth. And so they have to sit there and wait to get the income taxes. Whereas with Roth IRAs, they get paid up front, and I think like most people, pay me up front. And that works for me, because I'm sure that I'm getting my money now instead of possibly later. So no, I haven't heard anything negatively. I don't think anything is going to happen if my opinion counts.
So real quick, I want to get one clarification on these are all my questions for me. Okay. So if I do a Roth 401k, I want to go back to that. Let's say I start a Roth 401k. Does that start my 5-year clock, or does it need to be a Roth IRA?
It needs to be a Roth IRA. Excellent question. So you've had your Roth 401k for 6 years, right? You've never had a Roth IRA. You roll it to your Roth IRA, brand new Roth IRA. Guess what? The 5-year period for the Roth IRA just started. Okay. Does not carry over.
Okay. Excellent. So, this is, such a great education, I think, just for everybody, because it's not something, Merce and I work with IRAs all the time, not with the 5-year rule all the time. And so the idea is, okay, we want to make sure we're really clear on this. And that's why we're so happy to have your expertise and helping with us. Now, are there any things that you think that we've not asked that you say, hey, Radon, make sure you guys are thinking about this? Anything around, whether it be the 5-year rule, IRAs, Roth IRAs, anything like that you think, hey, this is something I see that people overlook, or we want to make sure that we hone in on that?
Yeah. There are a lot of things to think about when it comes to the 5-year rule for determining if a distribution is qualified, right? The one that you just talked about, 401k, Roth 401k doesn't start it for the Roth IRA. It starts with the Roth IRA. If a spouse beneficiary inherits a Roth IRA, the 5-year period, if the spouse treats it as her own, let me just say her, simpler. Yeah. If she treats it as her own, then her husband's 5-year period and her 5-year period are merged, and she gets the earlier of the two, right? But if she moves it to a beneficiary IRA or any non-spouse beneficiary, they inherit the 5-year period for the decedent. And so the beneficiary needs to know that this Roth IRA that I inherit met the 5-year period, because it doesn't start with me, it starts with the decedent. And so, accountants need to ask that questions for inherited account. Do you have documentation that shows when the account was started? Because if it has been at least 5 years, now we have an inherited account, then everything's tax-free and penalty-free. Because for qualified distributions, it's 5 years and either death, disability, 59.5, or up to $10,000 for first-time home buyer purposes. So beneficiaries would be tax-free, penalty-free if the 5-year period has been met.
All right. Well, very good, Denise. Thank you again for hopping on today. Clearly, there are things that you need to think about when it comes to Roth conversions, 5-year rules, IRAs, retirement planning in general. And so that's why we've decided to, partner with Denise as a consultant to have in our back pocket when we have questions like this to answer for our clients. But if you're listening and, it's always going to be good to have an expert on your side when it comes to these nuances that can potentially get you in trouble down the road from a tax perspective if you didn't think it through all the way. So we are here as always for any questions that you have around this topic, this episode, or anything else that we've discussed in the past. And we're always happy to bring as much knowledge to the table as we can. So Denise, thank you again for being here.
You're very welcome. And they should contact you about RMDs too. RMD season's coming up. You guys are very good when it comes to that. So hopefully they'll contact you with their RMD questions as well.
Yeah, thank you very much, Denise, for bringing that up too. And I always like to remind people, if you do have questions, you can just go to the website, go to the top right-hand corner, click on schedule call, and it's a 15-minute call that you can get on the phone with myself or Merce, and we'll try to answer any questions you have. And if we get stumped, we always reach out to Denise. So thank you very much, Denise. We appreciate you coming on today.
You're welcome. Thanks for having me on. Have a great day.
We hope this video has given you some confidence and clarity as you plan for a worry-free life in retirement. But what else do you need? We have created a complimentary video course called 3 Keys to Secure Your Retirement. This video walks you through step-by-step what you need to do to get ready for retirement. You can also check out our podcast called Secure Your Retirement. You can subscribe below.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.